Nomura's Prabhat Awasthi, and he is a day after CLSA panned the prospects of consumer staple sector in India. There is a contradictory view coming in from him. In an interview, Prabhat Awasthi, Managing Director of Nomura India, says that investors must hold on to consumption stocks in general, autos being the only exception. He, of course, was in conversation with Nick Kunj.
Consumption usually is far more resilient in the short term than investment, and that is because even now, for example, anecdotally, that India has faced a labor shortage, and that is not really eased. I mean, you're not seeing salary cuts in India. The salaries are still rising, though at a slower pace. As investment cycle starts to come off, there will be at the margin impact on consumption because job prospects will start fading, salary increases will reduce, and stuff like that, and therefore there will be a slowdown in consumption. I think where the stock prices of consumer stocks were, they were reflecting more of a fear premium than really the absolute level of fundamental multiple at which they should trade. The question is, in a slowdown situation in overall economy, will that relative trade hold out or not? And I guess if you're 2 years slow on growth, which is our forecast, for example, closer to 6%, then that relative trade will probably still hold out. There might be periods when there is a risk on and these guys underperform and people try to shift their portfolio away from defensive and you see
so don't sell consumer names.
I think you need to, even if in a portfolio, I think it is still very advisable.
Within the consumer space, what are you hot on? Discretionary, staples,
discretionary more risky because there are two reasons. Discretionary are have more urban-centric sort of consumption, right? So urban-centric consumption is probably suffering more on account of the fact that there is a clear shift towards rural consumption and the rural terms of trade have become better. I mean, we've seen a 20% increase in MSP. And any impact of industrial slowdown will be first felt in urban India, not in rural India, because they're still far more insulated. So as a result of this, discretionary probably will suffer more, which is what, again, you're seeing in terms of, you look at the number of, let's say, a Bajaj Auto versus a rural-focused player, and you can see the clear difference in growth rates. I think that might be more advisable to sort of be lower in the pyramid chain and be in lower penetrated categories than higher penetration, more in rural, less in urban.
So what are your overweight recommendations? You're not hot on banks. You think consumer is slowing down. It's too early to buy investment. So if a client walks up to you and his queries, give me some ideas which I should buy and hold on, where I can.
So you would have asked me buy ideas for 5 years and market would have gone down, right? So the problem in markets of this, which are range bound at best, is the fact that markets are not going anywhere, and therefore it becomes very, very difficult to. And we are always bullish, right? So we sort of say what to buy. When the overall markets are down 20% over the last 5 years, we've all been sort of thinking of what to buy. End of the day, it's a relative game when the overall environment is lackluster. And to that extent, our view has been that you got to buy companies where the earnings protection is high. Now, this could be your utilities. This could be, and obviously, we would underweight telecoms at higher prices of telecom. But it could be that the sector is starting to stabilize. That could be telecoms. It could be, pharmaceuticals, where there is a very clear identified opportunity of patent expiries, rupees in their favor, and the sector dynamics for next 3-4 years are extremely favorable. So you got earnings growth, and the rural. The penetration of healthcare is still very small. So the growth in domestic market is still very strong. So those kind of companies, obviously. But, obviously you'll not be able to make 100% of portfolio of these kind of names because the fact is that there is still a very large weightage of banks. So within banks, you need to be more defensive. You have to have some financials in your portfolio. You can't make them zero. But I think...
Buy the private names, don't buy the PSU names?
That sort of bias, correct.
What are your high risk, high return ideas?
High risk, high return ideas. I think, so basically, the high return in large caps, I think, is going to be very difficult from these levels. So if you're looking at high return, then you'll obviously have to tilt towards mid caps. And then, so we have a bunch of mid caps we sort of like. A few of them have been destroyed by policy action. Gas names, have sort of evaporated. So we cover. So for example, McLeod, we really like that company because we think there's a global cycle in offing and there's a big benefit happening. But you will get into stock specific sort of when the overall macro is very weak or slow, then you're not really betting on an economy trend to make your returns. You're probably betting on company specific factors, some narrow industries which will do well in an overall environment where things are slow.
So apart from McLeod, anything else in the mid-cap space which excites you?
As I said, these will be, so there will be some smaller banks which still have growth, for example, like IndusInd Bank, because it's still growing very strongly.
Do you think IndusInd is small? It's got a decent market cap?
Yeah, but the fact is that if you are betting on market cap gains in a large market, a small bank which is still growing at you've seen, HDFC Bank sort of reminds you of that in terms of growth. Obviously, HDFC Bank done this for a long period, compounding at 30%. But smaller companies in a decent sized market, which are executing well, will tend to do well over a period of time. Then we like, for example, in tech space, even though there are some short-term headwinds, we still like smaller companies compared to the larger ones, where we think there'll be more headwind. We like, actually autos is sort of now we're underweight on. And I think there might be some case for gas names if really the overall, for example, PLNG, etc. There will be a case primarily because the consumption still is in the up. But obviously we need some clarity on the regulation because clearly the regulation has come on their side because of the court verdict. But still there's, investors have become extremely wary of buying anything in India which has got any whiff of regulatory issues involved. But there might be a case for doing that. And anything which has got regulated returns, frankly, but you don't have too many small caps there. But a Power Grid, for example, we really think that stock will do well. It's done really well. It's held down. It's really appreciated in a market where market has gone down on overall basis.
What role do you think IT stocks will play next 1 year? Because the headline growth number for at least large cap IT companies seems to be slowing down.
So I think there are two things which have happened in IT. Clearly, global growth environment has weakened. Europe is in a funk, and even US, clearly the volume growth has not been as strong as was expected, despite the US recovery. Right. So clearly that essentially means that from 18% sort of growth, volume growth number, you've gone to 12 to 14%, even lower in cases. And that has been a big disappointment. On the other hand, rupee has depreciated. However, if you look at the forecast of rupee and the belief in this level of rupee sticking is close to zero. So the fact is the benefit, IT stocks have not really benefited from rupee depreciation because people continue to think there are a lot of people are saying rupee will go back to 50. So go back to 50 and the sector growth has done, really badly. In that case, you obviously won't buy IT stocks. But I think on a relative basis, the sector should still be all right, especially from these levels. You could have negative reaction to the current coming up results which is coming up because I think there has been clearly a demand side weakness, and that might mean that going into the results, the stock might be volatile, even down after the results. So one has to be cautious around that time. But I think in a relative context, IT is still fine. Actually, they've done okay in relative context to the market in last 3-4 months. They've outperformed the stocks.
But within the IT space, is the pecking order changing? It's no longer Infosys?
No, it's no longer Infosys. You're right. So our thing is that sort of in very large, the absolute large caps, TCS is what we liked. We sort of been liking better, and in mid caps sort of been pushing, or smaller companies, not smaller, but in the second rung, HCL has been a top pick in the sector.
So before we wrap the show, final question, what is your big call for FY13 and then beyond? Sit on cash, protect your capital, time to high beta has not come yet?
Yeah, time to high beta can, I don't think there's really time for high beta. Our view has been that markets will be flat through the year. And you can go wrong by 5-7% here or there, but I think the enabling conditions for the market to do well has to be the growth, that sort of underlying growth, and that is what you pay for, especially in an emerging market like India. Until the time you get clarity on that, and you're convinced that growth is going to come back, even I'm not talking of 8-9%, but I'm talking of 7-7.5% visibility. I think it's very difficult for the market multiples to move beyond 13-14 range. If not lower, I think they could probably.